The liquidity is gone. It hasn't disappeared from the screens where digital numbers blink and flash in milliseconds, but it has vanished from the real world. In the vaults, in the mines, and specifically inside the borders of the world's largest manufacturing superpower. Huge news is coming out of China regarding physical silver turnover. And if you're only watching the spot price on your phone, you are looking at a mirage. Ray Dalio warned us about the changing world order and the shift of wealth from west to east. We are watching that prediction manifest in real time, not in gold, but in silver. Over the last few weeks, the silver market has moved through a phase that can only be described as unusually intense. We've seen violent price action, confused sentiment, and a pullback that has unsettled the average retail investor. But what if I told you that this price drop isn't a failure? What if I told you it is a mechanical flush, a deliberate clearing of the board before the most significant structural shift in silver history takes place? Welcome to Veiled Wealth. Today, we are uncovering the hidden mechanism behind the crash, revealing why China is bypassing Western pricing, and explaining why the liquidity crisis in physical silver is about to change everything. Let's address the elephant in the room immediately, this recent pullback in silver prices. It has been sharp, it has been aggressive, and for many in the community, it has been financially uncomfortable. But from an analytical perspective, does this signal the failure of the broader trend? The answer is a resounding no. Instead, it reflects a market that moved too far, too fast, and is now undergoing a necessary digestion process. Silver surged sharply over a compressed time frame, pushing technical indicators like the RSI deep into overbought territory. That kind of vertical move almost always invites a correction. Not because the underlying story has broken, but because leverage builds faster than capital can support it. When prices rise rapidly, futures traders, the paper participants, become more exposed. They borrow heavily to chase the trend. But eventually, the bill comes due. Margin requirements rise and weaker hands are forced out. This is precisely what has been unfolding. Recent increases in margin requirements by major exchanges have added pressure, forcing traders to either post more capital or reduce positions. The resulting liquidation has pushed prices lower in the short term, but this process is best understood as a mechanical reset rather than a fundamental reversal. It is a paper event. It is a cleansing of the speculators to make way for the accumulators. While Western traders are panic selling due to margin calls, something profound is happening in the East. From a structural standpoint, silver remains supported by a convergence of supply constraints and expanding demand. But the epicenter of this story is China. For years, China was a net exporter of silver. That era is over. Domestic production in China has been gradually declining due to ore grade degradation and stricter environmental policies. Yet, at the exact same time, their internal consumption driven by solar panels, EVs, and advanced electronics is skyrocketing. That imbalance is forcing China to rely increasingly on imports at a time when access to foreign supply is becoming more contested. This is where geopolitics enters the market in a meaningful way. China's growing emphasis on securing strategic commodities, including silver, is increasingly intersecting with Western efforts to restructure global supply chains. We are seeing export restrictions, trade realignments, and the strategic treatment of raw materials. These are no longer theoretical discussions. They are actively shaping flows of physical metal. Reports suggest that Chinese buyers have been aggressively seeking physical silver directly from producers in Latin America, sometimes offering prices above prevailing Western benchmarks. Think about what that means. They are paying a premium to bypass the COMEX and the LBMA. That behavior is notable not only because of the price signals it sends, but because it indicates urgency. It suggests that certain buyers are less sensitive to near-term price fluctuations and more focused on securing physical supply. This aligns perfectly with the big cycle concept discussed by macro analysts like Ray Dalio. When an empire rises, it secures resources. It prioritizes possession over profit. That is not the behavior of a speculative trader. It is the behavior of an entity that views silver as a matter of national security. In this environment, silver is no longer just a commodity. It is becoming a strategic input, a financial instrument, and in some cases, a form of collateral within emerging financial structures. But this creates a problem, a massive disconnect between physical demand and paper pricing. One of the most important indicators to watch right now, and something we emphasize heavily here at Veiled Wealth, is not just the nominal price of silver, but the spread between prices in different regions. When prices in Asia begin to diverge meaningfully from prices in Western exchanges, it signals that the market is struggling to reconcile where silver is valued most with where it is most easily traded. This tension creates volatility, it creates dislocations, and at times it triggers sharp price movements that seem disconnected from conventional narratives. Western markets remain dominated by futures trading and exchange inventories essentially, paper promises. Eastern markets are dominated by physical delivery. These dynamics are currently being amplified by the structure of the futures market itself. Rising margin requirements increase stress on leverage traders, particularly those holding short positions. When traders are forced to reduce positions due to capital constraints, it can trigger cascading effects. Prices fall, which forces more traders into margin calls, which causes further selling. That cycle can drive prices lower even in the presence of strong underlying demand. However, it is precisely during these moments that the structural health of the market is tested. If physical demand absorbs the selling pressure, prices stabilize and eventually resume their upward trend. From a technical perspective, the market is now working through key support zones that previously acted as resistance. This is a normal process in trend development. Former resistance often becomes future support, and a successful retest of these levels tends to confirm that a breakout was genuine rather than speculative. Now, we need to discuss the most critical shift that nobody is talking about: the shift in institutional psychology. For most of the modern trading era, institutional participation was guided primarily by price efficiency, yield optimization, and relative value. Capital flowed toward assets when expected returns were attractive and away from them when valuations became stretched. In that framework, commodities were largely treated as cyclical inputs or tactical hedges. But that framework is dead. What is changing now is not merely the level of institutional interest, but the motivation behind it. A growing share of institutional buyers are no longer approaching commodities, and particularly strategic materials like silver, as assets to be traded around price fluctuations. They are approaching them as assets to be secured regardless of near-term price movements. This change is being driven by a broader redefinition of risk. Traditional financial risk was defined in terms of volatility. Today, risk is increasingly understood in terms of access. Institutions, whether they are sovereign funds, central banks, or industrial giants, are being forced to confront the possibility that assets they depend on may not be available when needed, regardless of how much they are willing to pay in the moment. That introduces a different calculus. Instead of asking whether an asset is cheap or expensive, the question becomes, will we have it when the supply chain breaks? Once access becomes uncertain, price becomes a secondary consideration. This dynamic is especially visible in materials that sit at the intersection of industry, finance, and geopolitics. Silver is the clearest example. When assets take on that character, they stop behaving like traditional investments and start behaving like strategic reserves. Strategic reserves are not built based on price timing. They are built based on necessity. Institutions accumulating such reserves are willing to tolerate higher prices, storage costs, and opportunity costs because the perceived benefit is not profit but assurance. This brings us to a terrifying feedback loop. In classical economic models, higher prices reduce demand. That is Economics 101. But in security-driven markets, higher prices may actually accelerate demand. Why? Because as prices spike, institutions race to secure access before conditions worsen. This creates self-reinforcing dynamics where price increases attract more buyers rather than fewer. This also changes the way volatility is interpreted. For speculative traders, volatility is a risk to be managed. For security-driven buyers, volatility is a signal of instability that justifies further accumulation. When prices swing violently, it reinforces the perception that markets are fragile and that reliance on spot availability is risky. As a result, volatility feeds security-driven demand rather than deterring it. There's also a time horizon mismatch emerging. Security-driven institutions operate on horizons measured in years or decades. Traders operate on horizons measured in days. When these groups interact, price movements become distorted. Long-term buyers may step in aggressively during downturns, not because prices are attractive in a trading sense, but because downturns present opportunities to secure supply quietly. This behavior undermines the stabilizing role that price traditionally plays. And because security-driven demand is often opaque, operating through private contracts and off-exchange arrangements, it reduces the visibility of true demand. So where does this leave us? Ultimately, silver is navigating a transition from being a peripheral asset to a central one within multiple economic and strategic frameworks. That transition is inherently unstable. It forces repricing, reallocation, and at times confrontation. For investors and analysts alike, the key is to separate noise from structure. The noise is in the daily price swings, the margin adjustments, and the emotional reactions they provoke. The structure is in the supply trends, the demand drivers, and the geopolitical context. At this stage, the evidence suggests that silver's underlying structure remains supportive of higher prices over time, even if the journey there is volatile. The current pullback, rather than undermining that view, may ultimately reinforce it by removing fragility from the system and allowing the next phase of price discovery to rest on firmer ground. In a world that is becoming more fragmented and less trusting, institutions are responding by building buffers. And those buffers increasingly take the form of physical assets. Here at Veiled Wealth, we believe the era of cheap silver is being dismantled, not by speculation, but by necessity. The price you see on the screen is the price of paper. The price of possession is a different story entirely. If you want to stay ahead of the curve and understand the wealth transfer before it becomes headline news, make sure you're subscribed to Veiled Wealth. Hit the notification bell. Let me know in the comments below. Do you think the paper price will collapse before the physical supply runs out? Until next time, keep your eyes open.